I want to bring in two women who really know. They're experts in all of this stuff. Bull Tech Capital Markets Chief Strategist, Kathryn Rooney Vera. Optimal Capital Director of Strategy, Francis Newton Stacy. You know, I love you guys when I bring you on because that's 6 names that I have to contend with. let me start with you, Francis, because of these 3 potential scenarios, which one makes the most sense to you? And by the way, how should we be invested in that particular scenario?
Right. So right now, obviously, the tech sector is the new defensive sector, which is very odd. And you can see that the market is trading the news on the uptick in cases. And of course, we still have a lag in the deaths. So it kind of remains to be seen how that plays out. We have earnings kicking off next week. That's going to be very interesting. There's so much, I think, that is priced into the market. It will be interesting to see if there are surprises. In the short term, I'm watching 31.25 on the S&P 500. If we start closing below that and get some downward momentum, we could see a sell-off. Other than that, I really pretty much expect stocks to kind of chill for the rest of the summer. I see the new real risks ahead as being when the airlines are able to lay people off at the end of September and when those loans come out of forbearance at the end of October. And if we lose that extra $600 a week, it's going to be interesting to see how many more loans go into forbearance. Right now, we have 100 million loans outstanding in forbearance, and we have no idea what the default rate's going to be. If the default rate is huge, then we see our bear scenario, Charles.
So you sound like you're more on the bear side, Kathryn.
Well, I couldn't agree more with a lot of what Francis said, and I'll add one thing that if you get a surprise, I mean, we have $10 trillion in a surge in equities that's all based on earnings that no one knows what they're going to look like. So I think the markets are certainly discounting the best. That's what I think. That's why we're recommending, Charles, a barbell strategy, which you want to place yourself in defensives and undervalued sectors. Defensives, I couldn't agree more with Francis. Technology is incredible. It's such an incredible sector, Charles, because structurally it's become defensive. Tech, if you look over the vacillations of the equity markets since COVID erupted, technology has outperformed on both up and down market days. So that tells us that it's a defensive, right, while at the same time being a growth sector. So I think that you want to be in tech, and I think on the undervalued side, in this barbell approach, Charles, you want to be in banks.
Wow. Okay, that's an intriguing thing. You know, along that line of thinking, you know, one thing that seems certain right now is that the old school hedging has really been a disaster. I mean, you consider that this is the year that hedge funds should have outperformed the market. So a lot of people have been trying to mimic that, a lot of individual investors. Obviously, if the pros can't make it work, then what should they be considering? You know, Kathryn likes a barbell approach. Francis, is there some sort of general approach for investors to look at this market that you think, because hedging, you know, being short and long at the same time has been an unmitigated disaster for most?
Yeah, so it's very interesting. If we see a little bit of an uptick in inflation, and I mean a very tiny one, you're going to have a stagflationary play, which is usually utilities, REITs, those kinds of things. However, utilities under pressure today, given that the economy is not really necessarily on the direction to open up strongly as we thought. We're not sure. The viruses are up, so the tech is playing that defensive role at the moment in time. But the minute we sort of start to see, cases kind of decline or something go right there, I think we're going to see a small uptick in inflation, and that's utilities and REITs and things like that. You know, we could have a lot of deflationary risk, which is another massive sell-off. Of course, there you've got treasuries and gold and all of the, quintessential, the U.S. dollar. But that, I think, probably we're not going to see until we see credit risk at the end of October.
You know, both of you ladies sound a little pessimistic, and I got to tell you, it's interesting because the media, financial media narrative all year long has been sort of this horde of millennial traders have goosed this market up on unbridled optimism. But when you look, the evidence really is not there. The VIX still well above, its normal levels of the fear index. And then I know the most recent American Association of Individual Investors optimism poll was extremely bearish. And Kathryn, I thought that was typically good for the market when most folks were bearish or feeling like something bad was going to happen.
Let's make it simple, Charles. And I say that it's difficult to say that, but let's try to make it simple. The U.S. economy is based on consumption. 3/4 of aggregate demand comes from consumption. Domestic demand incorporates both consumption, which is spending, and private investment. So if you get a trend pickup in consumer confidence, we've seen very good data, spectacular data for 2 consecutive months from the Consumer Conference Board of Consumer Confidence, both future and current sentiment, as well as from Michigan. If that continues, then I think this market 45% surge has been validated. If it retraces, then we should expect this V-shaped recovery, both economic and market, to become a W.
All right, a lot of unknowns out there. Kathryn Rooney Vera, Francis Newton Stacy. Thank you both very much.